Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending January 24th, 2020. So this is a daily chart of the S&P 500. It was a holiday shortened week, so only 4 days, down 1% on the week, most of that Friday. The key focus of the week was this coronavirus out of Asia or out of China. And I think about a dozen large cities in China are under quarantine, over 50 million people. And that comes right into the Chinese Lunar New Year. It would kind of be like the same as canceling Black Friday or canceling Christmas here in the US. So S&P down about 1%. Small caps really showed weakness back here the preceding Friday. This is Friday, I think it's the 17th, yeah. So that's a dark cloud cover. That's the open here, close there. That is a bearish candle. And the S&P closed up this day, but small caps basically have been really good this year in 2020 as far as leading the broader market in terms of relative strength. Here's a big week of relative strength. This is relative weakness on that Friday coming into this week, and they were down more than 2%. This upcoming week, who knows what's going to happen with this coronavirus? That's out of our hands. We do have a big week of earnings ahead with the large cap tech stocks, the FAANGs. Quite a few of those will be reporting next week, and we have the Federal Reserve on Wednesday. So a couple things to pay attention to. I'm going to touch on a few different asset classes, a few S&P sectors. So let's get started. Let's take a look at a few nearby resistance levels or magnetic levels for the major averages. This is a 5-minute chart of the S&P 500 for the week. You can see pretty flat the first couple days into the week. This is where we saw relative weakness in small caps. And here I've thrown IWM up on the chart and normalized it to the S&P, and you can see that relative weakness over here. So that pretty much led the weakness into this week. I pointed out to members early in the week that although the S&P was kind of trading sideways here, this wasn't a bullish consolidation because it was expanding a level of attraction here around 3,300. You can see it right there. So we had some initial support after some weakness here Thursday, and here is Friday. So really, right from the open, just down all day. And not a big sharp drop down, but a persistent grind lower. And you can see kind of ended the day trying to rally back into that 3,300 level. Here's a 5-minute chart of the Dow, and a key level for the Dow was 29,000 right here. Got a little bounce from that, broke down below and rallied right back into it to close out the week on Friday. There was a lot of developments in S&P sectors, and we're going to touch on a few of those. But first, let me say, going into next week, we have earnings coming from Facebook, Amazon, Apple, Microsoft, and Google. Apple will report after the close on Tuesday, so that should be a pretty important day. And one reason I mention it is because these stocks have led and really supported the broader market all through January. So we might as well go ahead and start with technology. This is XLK, the technology sector, 30-minute chart. Here's a broadening formation. Things getting a little iffy going into December, and a very strong trend. So you can see this trend comes up to around the 96 level. But look how it accelerates in 2020. The two best performing sectors in 2020 are technology and utilities. That's a strange mix because one is a secular growth sector and the other is defensive, but they're both momentum factors. One of the reasons I didn't think the market was going to really break down bad this week was because of those tech earnings coming up. And XLK, although it did break below this 2020 trend line, my opinion was that it wasn't going to break this more important one until the market hears what the earnings are going to be from these large cap techs like Apple. If those earnings disappoint and this tech sector, XLK, breaks below this trend line around 96, then I think you're going to have a very, very ugly market for the S&P, for the NASDAQ, even for the Dow. So while we're covering the FAANG heavy sectors, we might as well go to communications. Again, a 15-minute chart for communications. Facebook, Google are good examples. Here is a break this week of the trend line. Now, like technology, I have two different trend lines. You have this one going into December, and then you have this accelerated one because these stocks were really in favor in 2020. So that accelerated one, like technology, is broken. This one is around 55.50. So we'll see what those earnings look like from Facebook and from Google. But this is one you're also going to want to watch. Sticking with those FAANGs, this is a FAANG heavy sector again. Consumer discretionary. We looked at how this was trading back here. Wasn't doing great. Had a false breakout. and then just really zipped into 2020 with those FAANG stocks being bid. So as you can see, we did get a trend break over here this past week. Maybe we see a little bounce and a back test up to this 127.50 ahead of those earnings or into those earnings, but we will probably see something more definitive after those earnings. The materials sector, and this is a very, very lightly weighted sector, so it's not influential in moving the S&P 500, but it's very growth sensitive. And I have a lot of trend lines, but it's just because it tells a story as the events have developed. This is kind of a barometer or a bellwether for economic growth. Some of the important stocks in this sector would be international paper. So for example, they make paper, cardboard boxes for shipping. If you expect economic growth to pick up, you expect a company like that to do well. Or Dow Inc., which makes plastics, same thing. The key takeaway is this transition we've talked about from a very strong uptrend in October and November, and then going into more indecisive sideways action, some bearish changes in character in price action. The week preceding last week got a pretty good bounce and it was up on the week, but it really is kind of like a bearish flag. It didn't do enough to break that bearish consolidation, and this is what happened this week. So you can see it broke down below that flag. It really opens the door for more downside. More important than its effect on the broader market is the message that it's sending about economic growth. Here's a 60-minute chart of the energy sector. Again, a lot of trend lines, but the main takeaway is this is what we saw coming into this week. We had a pretty decent downside move, and you can see it found support over here. And my opinion was that this was a first leg. This is a consolidation, and we were going to get a second leg. That's what we got this week. This vertical line is actually my measured move target. So it's right above 56, but there is an area of support here. So I would say energy, which really got thrashed this week, may find some support here around 56 early next week. But a real ugly move down here in another growth sensitive sector. And that's because crude had a horrible, horrible week. This is the financial sector, 60-minute chart. Really interesting sector. It's the third most heavily weighted, so it's very influential. We have a bullish trend, a bullish uptrend. We have bullish consolidations, and then we go into this 5-week lateral rectangle consolidation. I have favored this sector breaking down. This is the regional banks in white, and you can see that they have been leading the financial sector lower for a couple weeks, and we finally saw a break of support here right around the 30-50 area, following those smaller regional banks and following the yield curve. An interesting takeaway from this is that financial sector is not so much growth like materials or energy or industrials, but the flattening yield curve is the bond market sending a signal that it is expecting lower economic growth or more disappointing economic growth. And here's an example of that. So this is XLF in the red and green candles, that lateral trend that I was just showing you. And this is the spread between the 5-year and the 30-year yields, or the yield curve. So you can see it's been flattening out. So the bond market has been sending a message really since about the trade deal, the time it was announced about mid-December, that growth expectations are moving down. So maybe that's the bond market saying not so impressed with the trade deal. Maybe it's not going to spark the growth that the market has been assuming and pricing in. But the net effect on the banks is that it squeezes their net interest margins. You can see the yield curve has been leading lower, and that pulled the regional banks lower, and now we're seeing the financial sector move lower, breaking some support here. Remember, it was the financials that kicked off earnings season a week or so ago, and I was kind of interested to see if maybe earnings would help them break out. So far, no. Okay, another important growth-sensitive sector, industrials. While the broader market was down last week, I was impressed that XLI held support at this local level, about 83, and then it's got another level here in play around 82.25. Another area to watch is transports. They tend to lead the industrial sector. This is a really key level I've been watching for months. It's 10,950. You can call it 11,000 is kind of close enough, but it's 10,950, and it did hold that last week as things got ugly in cyclical sectors. Okay, this is consumer staples, so it is a defensive bond proxy sector, and these are the sectors I've kind of favored on the long side because they have an advantage in the way that the bond market is acting, the way yields are acting. A couple weeks back, I said that this sector at 61.75 or thereabouts, near this trend line, which is the 2019 trend line, it's held it really spectacularly, is a really interesting buy, and it has done great since then. Again, it's a defensive sector, so if there is a risk-off move, this sector should hold up better. This is the best or the second best performing sector of 2020. It also is defensive. It's also a bond proxy. This is the utility sector, XLU. What's interesting is we saw some rotation towards the value sectors, the beaten up value sectors. And I had said at the time, XLU utilities were not getting a lot of attention back then because they were going for more speculative kind of growth assets. But it's really interesting how these have really performed over here into 2020, just as strong as technology. Here's healthcare, XLV, 60-minute chart again. Early in the week, we saw this breaks a minor trend, and because it's the second most heavily weighted sector, I thought that this was going to put some downside pressure on the broader market because we have a first leg down, a consolidation, and then we saw that second leg into Friday breaking this trend line. So if you look at technology is kind of holding this kind of trend line. Then you have communications and consumer discretionary. So a lot of sectors that are still close to these really supportive trend lines, but are starting to break them. Uso Crude Oil. We've had some really good calls with crude oil. You may remember this broadening formation. It broke out of this broadening formation, and this is the Iran geopolitical tension. What I had said about a week or so ago was that if WTI crude could get over 59, basically negate this kind of bearish consolidation, then it had a chance. But if it didn't get above 59, and I'll show you in a minute, that we were going to see a second leg lower. Last week, second leg lower. So here's WTI Crude Futures, and this is a 30-minute chart. This red trend line is that broadening formation that I showed you. This is the geopolitical tension, Iran risk premium. And here's that consolidation. So this is why it said, if it gets above 59, it has a chance. It will run into some resistance here at 62, but it never got above and held 59. So this past week, we got an equal leg lower. My downside target for WTI crude is $53. There is some minor support here, 54. I think it probably could go down to 53 and then probably consolidate again. Here is GLD for gold, the gold ETF, and this has been really fantastic price trend. I think people lost interest in gold because this was 5 months of consolidation, but it was bullish consolidation, same as this one over here, kind of a descending wedge or a flag-like formation. And we already saw a breakout and a first leg higher. And then we moved into a consolidation that kind of looked like a bullish flag. We'll take a closer look at this, but remember you have a first leg here and a consolidation. This is a 15-minute chart, and you can see that kind of flag consolidation. And what I noticed early this week, and I had pointed out to members, was this bullish ascending triangle that was starting to develop. And one of the reasons I mentioned it, one, it's a bullish consolidation, but two, it's really defined. You could enter gold or GLD anywhere in here, put a stop down here, and have a very small amount of risk, and then you know exactly where the breakout point is, which was about 147 for this triangle, and you could have a stop down here around 146. So it made a lot of sense. It was a good risk-reward position. We see more of a risk-off move in markets in the next week or two. You'll see gold get a safe haven bid and move higher. I'll show you what my general target is for gold or for GLD. And we're back to that daily chart. There's the breakout, first leg, and consolidation. So this is about a 6% move. So my upside target on a breakout from this consolidation, which it's just starting to now, is about 156.75 to 157. That's a really attractive risk-reward proposition on gold, an asset that is just acting beautifully and acting much better than it should be, with the major averages trading at or near all-time record highs. Another asset class that looks very similar to this in terms of a bullish consolidation is bonds, or TLT. So you can see a nice clear uptrend in 2019, bullish consolidations, and then we get this big kind of triangle consolidation about 5 months, much like gold. And we'll take a closer look at this. Here's that triangle consolidation. And a couple of weeks ago, I said I think TLT is going to 136. I think we'll find support. When it got down there, we saw a really strong 3C signal, buyers stepping in right at this level, and it has done great since. Ran right into that resistance, pulled back, and breaking out this past week. That is safe haven flows for one, but it's also economic growth being marked down with bond yields tumbling and yield curves flattening. VIX We bought volatility about 2 weeks ago. Here's the daily chart of VIX, and just note this trend over here. This is a relative strength trend. S&P 500 has been making higher highs, new record highs. Usually volatility would be making lower lows. The last time this kind of relative strength trend, while the S&P was making new highs, occurred was in 2007, right before the financial crisis. And here's VIX rolled back 2005-06. You can see making lower lows as the S&P was making higher highs. We get into 2007, we had the same kind of situation we have now, relative strength. And I'll show you what happened next. And this is as a result of the financial crisis. So volatility exploding higher. So here we are back, VIX now. We bought this about 2 weeks ago for a couple reasons. One, this trend, so it made sense to look at a purchase in the $12 area. And the another is a signal that I never ignore, and we almost always see a double-digit move in volatility. This is a 60-minute chart of VIX in green, and this is the absolute breadth index in white. So when it gets down to extreme multi-year lows is when it's giving a signal that the market is primed for a move up in volatility. The last one we got over here, and this is the last time I recommended volatility. I recommended it right here, and the next day we got almost a 40% move. Well, we got another one of those signals right here as VIX was trading near $12. And notice it kind of makes that low signal and then tends to lead volatility higher. Here's that low signal tending to lead volatility higher. So we're off to a good start with our long in volatility out to March. So wrapping this up, where we started, the S&P 500, you can see this trend was broken last week. And we have the same thing in the Dow. And NASDAQ is pretty darn close, either at that trend line or having broken it. And I think this is why next week is going to be important in terms of those FAANG sectors. So my view was that this trend line was not going to break until we get the earnings from these tech companies. And if those earnings disappoint the market, with all the extreme valuation that's been built in, it could be pretty ugly pretty fast if they miss, the market's disappointed, and this trend line breaks. So that's one to watch next week, XLK around the 96 level. Watch financials, I showed you them. Industrials is another one. The communication sector, because we do have other FAANGs reporting. S&P 500 did close off the low on Friday, but a big bearish engulfing candle. And small caps, you can see they also closed off the low, but another very ugly bearish engulfing candle. My feeling was that Monday we maybe see some follow through on the selling, and then maybe small caps start showing some relative strength of performance. I think volatility will come under pressure by Tuesday ahead of the FOMC on Wednesday. I think the key thing you want to be aware of and watch for from the Fed on Wednesday, because they're not going to change rates, is whether or not they're going to dial back their repo operations. Looking at this weekly chart of the S&P 500, this is when the Fed's balance sheet started expanding by about $400 billion. There were only 3 weeks that the balance sheet dipped. Those 3 weeks were this week here, and last week. The only 3 weeks the S&P 500 closed red since that balance sheet expansion started. We have seen a lot of red flags during this rally, but the liquidity from the Fed has trumped that. Okay, you have $400 billion going into the financial markets, and if it even drops a little bit, the S&P is red on the week. The balance sheet expansion has covered over a lot of sins in thin paper, and if that gets dialed back by the Fed next week, if they say something about it at Wednesday's meeting, I think we could be in for a big surprise in the markets. So that'll do it for this video. Thanks for watching. If you enjoyed it, give it a thumbs up. If you have any questions or comments, go ahead and leave them in the comments section. I will post a link to a free post. It's actually the daily wrap from Wednesday. There's some interesting stuff in it. Wednesday of last week. I will make that free on the website and post a link to that. And I'll also have some of the stats for last week in the description.